Well, hello everyone. This is Wilson Cole, and I'm president of Adams, Evans and Ross. And I've had a lot of clients call me in recent days asking me, Wilson, with the ripples that are running through the banking industry, should I be concerned? And I mean, anytime that banking gets a little questionable, there's always a reason to pay attention. But there's certain segments of the population in the industry. If you were in those particular industries, I would be very concerned. If you're dealing with a lot of startups and a lot of tech startups, the situation out with Silicon Valley Bank, I happened to watch over the weekend a lot of founders and tech company presidents that were speaking. And some of these were the very same people we were talking to 90, 120 days ago or 6 months ago, where they were behind on their bills to recruiters and staffing firms. So if the credit lines dry up, it's definitely going to be a problem. Now, everybody says, well, Wilson, with Silicon Valley Bank, everybody's getting their deposits and things along those lines, and that is good. I mean, if it's their money, then it would be unfortunate for them to lose it. But one thing that people are not talking about is I would assume that those credit lines have been dramatically altered or no longer even exist. I mean, yes, you can get the money back because of the government stop gaps, but if they had $1 million line of credit, do they now have access to it? It reminds me back in 2008. And one of the things that we did, and there was obviously a flaw to our plan, is I used to own a tremendous amount, I say a tremendous amount, I used to own a disproportionate amount of real estate. And one of the techniques that we would utilize in the early 2000s is we would buy a piece of real estate, it would run up, and we'd put a credit line on it and either pull down from the credit line or just use it as a stopgap to basically as a credit line. We've been in business now 30, 35 years. We're self-funded and all of that. But back in the early to mid 2000, under 2010, we used credit lines as we were expanding. And that was kind of a cheap, easy way to do it. Well, one of the things that happened to us absolutely overnight is we had $1.5 million in credit lines on property, whether it was real estate, commercial, or whether it was single family housing. And it was there that I could always use as a backdrop if we needed to access cash. Overnight, those credit lines literally evaporated. And that's the first thing that happens in a bank squeeze, or at least it did in 2008, and I see no reason why it wouldn't happen now, is that the credit lines just absolutely evaporate. Now, a lot of people that are familiar with real estate say, well, Wilson, that could have been on commercial debt where you have a line of credit on a building and it may be amortized over 30 years or 20 years, but it has to reset every 3 years. And yes, that's the extreme case. But these were also on equity lines with residential rental real estate. They literally, we got a notification on all of those properties, all of the lenders, they were out of cash. And they basically said, hey, just want to let you know any additional availability on these loans are now gone. I can remember American Express had sent out, and I'm going back, this is 2008 when it was in the very height of the weird. During that crisis, American Express had sent out notices that if you paid your balance in full, they would give you an additional, I believe it was 3%. It could have been 5, it could have been 2, but they were actually paying you to pay your bill off in time. Now that was only about a month or so, but everybody was just kind of strapped for cash and credit lines. So my point being is, if you're under $250,000, it's really a non-issue. You're covered. If you're one of the folks that were with Silicon Valley Bank, you're getting your money back, but you probably have lost your credit lines. So just have backup resources. We, knock on wood, had enough cash to weather the storm in 2008, 2007, without having to go through massive layoffs or anything along those lines. And just make sure that you aren't banking, looking over at your checking account and saying, okay, we have XYZ dollars in there, and we've got a 50,000, $500,000 credit line or whatever. If the only thing that is keeping you from insolvency is a credit line, you probably want to find a backup plan to that, because that credit line, what a lot of people don't realize is that there's special wording in those contracts. They can cut that off when there has been no material downgrade to your own personal credit. My personal credit, corporate credit back in 2008 was fine. but the banks were in trouble. In fact, the bank that we had one of our credit lines with, 90 days later, they were out of business and bought by a bigger bank because the Fed shut them down. I don't think that it's going to be that epidemic, but I do think that you're going to see credit lines start deteriorating. And the first place that they go is to mid to small sized businesses to reduce their exposure. So make sure you've got cash, kind of sitting on the sidelines. If you've got, $500,000 in a corporate account, you probably want to go find a secondary bank and throw, a couple hundred, $250,000 over there as well. But just use your better judgment, but also have multiple pockets of cash. And this is something that should also put everybody on notice. Dealing with one bank is probably not the route to go. If you have a second or a third bank, always have a backup bank, just to where if something happens you hear rumors that your bank may be in trouble, just being able to write a check or do a wire to your secondary backup bank gets it out. Because one thing I'll tell you, and I'll get off my soapbox after this, but in 2008, we saw a lot of bankers come in here, a lot of banks come in. We've seen a few since then, but back 2008 and 10, it was epidemic. I can tell you, I was actually surprised at how combative and how unethical some of these banks could be. And you were dealing with at the very height of educated debtor when it comes to debt. When these banks were going out of business, they were making sure that they were very selective prior to that seizing of the bank on who was getting paid. So just be careful. So my suggestion one would be make sure that you have multiple pockets of cash. Make sure you have multiple banks, just to where if you have to move money over or something happened to your bank, you can make payroll or just the general covers. If you have a client out there that's having some cash flow issues, you probably want to keep an eye on those guys as well, because what I'm saying to you is the same thing that's going to be happening to the debtors, but it's going to probably happen a little quicker because they may have already been over leveraged. They may already have reached the top of that credit line, or they're starting to miss those payments with their bank. So keep everybody on a short leash. If you're in staffing, be very, very, very careful, because this transition period is when we see a lot of staffing firms get burned, when a lot of companies start trying to shift their payroll risk over to staffing firms. Great opportunity for growth, but a huge opportunity to get burned if you're dealing with somebody that's just trying to utilize you as a short and midterm loan source. If we can help you with any collections, please reach out to us. Go to our website at staffingdebt.com, or if you want to look for backdoor hires, go over to our backdoor hire website at backdoorhires.com. And thank you. Hey guys, it's Wilson again, and this video was brought to you by Adams, Evans, and Ross. And if you like the video, please make sure that you click on the subscribe button and also like the video. If you have any questions or comments, please leave those below as well. If you'd like to learn more about our company, please visit our website at staffingdebt.com. And also remember, if there's no collection, there's absolutely no cost at all.